Is there a hidden value explosion happening right now in technical textiles? Or is it a value trap? Today, we are diving deep into Garware Technical Fibres' FY26 performance to see if this company has the ultimate flight plan for your portfolio. To understand where this company is heading, we need a clear flight plan mapped out in 4 steps. First, we will analyze the core financials and unexpected Q4 surprises, focusing on revenue growth, EPS beats, and operating margins. Second, we look at balance sheet fortitude by assessing liquidity ratios, debt levels, and cash flow strength. Third, we will deep dive into individual segment growth engines driving future expansion. And finally, we will evaluate the valuation context to give you our final investment verdict. So, why should you look at Garware right now? It comes down to 3 things: impeccable health, strong shareholder value, and a structural moat. The company boasts a massive net cash surplus of 380 crore and 9 lakh rupees, with a virtually non-existent 0.03 times debt-to-equity ratio. Management is heavily rewarding investors, with a total FY26 dividend of 9 rupees per share, plus an ongoing 110 crore rupee buyback at 680 rupees per share, all while maintaining a global specialized leadership position backed by 101 active patents. Looking closely at the Q4 FY26 performance dashboard, a sequential recovery is firmly intact, driven by scale efficiency and normalizing global demand. Revenue hit 426.41 crore, marking a strong 10.11% quarter-over-quarter rebound. Gross margin stands at an exceptional 71.93%, up 57 basis points year-over-year. Normalized EBITDA reached 94.05 crore, up 10.36% sequentially, while the EBITDA margin held firm at 22.06%. If you look at the reported profit after tax, it seems to show a worrying drop to 57.26 crore, down 19.45% year-over-year. But there is a huge one-off anomaly here, a 13.90 crore rupee adjustment for Indian Labor Code restatements. When you adjust for these non-recurring regulatory mandates, the normalized profit after tax actually sits at a highly resilient 67.67 crore, proving that core operating profitability remains incredibly strong. Our visual reference of a secure vault represents Garware's incredible balance sheet fortitude. The company is virtually debt-free, actively slashing its total debt by 34% year-over-year, down to just 40.30 crore rupees. This leaves them with that incredibly safe 0.03 times debt-to-equity ratio, a massive net cash surplus of 380 crore and 9 lakh rupees, and a rock-solid 2.74 times liquidity ratio. When it comes to the quality of earnings, we all know that cash is king, and Garware displays exceptional earnings transparency. For FY26, the profit after tax was 198.67 crore rupees, and their cash flow from operations matched it almost perfectly at 196.12 crore, representing a stellar 1.01 times cash conversion rate. Even better, operations generated 139.74 crore rupees in pure free cash flow after accounting for all organic capex. Let's break down the segment dynamics, which reveal a perfect balance between a cash cow and a growth engine. The cash cow is synthetic cordage, bringing in a massive 81% revenue share at 349.65 crore rupees, with a high 25.10% EBIT margin, driven by global aquaculture nets and shipping ropes. The growth engine is fiber and industrial, pulling in a 19% share at 80.80 crore rupees, but growing at a rapid 10.92% year-over-year, thanks to geosynthetics used in Indian railway and infrastructure projects. Garware's long-term capital efficiency proves they deliver stellar returns. Capital returns remain significantly above capital costs, despite recent global supply chain realignments. The return on capital employed stands strong at 19.83%.
The return on equity is at an impressive 14.67%, and their interest coverage ratio is a massive 20.90 times, meaning they can cover their obligations with ease.
Looking at working capital, you might notice a visible graphic illustration of an inventory jump, with inventory increasing 47% year over year to 95.1 days. Is this dead stock? No. Management notes this is a conscious strategic move for safety stocking to support new European entities and shorten global delivery times. Meanwhile, cash collection remains highly efficient, with receivables actually improving to 66.1 days. Let's run through the diagnostic risk checklist to see if there are any hidden dangers. Is there a gap between profit after tax and cash flow? No. Cash conversion is excellent at 1.01 times. Are they relying on one-off gains? No, one-offs actually hurt reported earnings this time. Is liquidity deteriorating? No, debt was reduced by 34%. Is the inventory jump unexplained? It is monitored, but strategically justified due to polymer price volatility. Now for the big question. Is the stock expensive? Garware trades at a trailing price-to-earnings multiple of 31.0 times and a forward EV to EBITDA multiple of 14.2 times when adjusted for cash. While it clearly trades at a premium compared to standard everyday textiles, this premium is arguably justified and priced accurately for a high IP technical monopoly. Let's take a look at the graphic illustrating the company's undeniable structural moat. Garware protects its business with three core pillars: a pristine zero-debt balance sheet, a powerful portfolio of 101 active technical patents, and a high-margin monopoly in specialized nets that prevents competitors from easily stepping onto their turf. This brings us straight to the final investment verdict. Past U.S. tariff hurdles are now definitively resolved, clearing a massive runway for sports netting export growth in FY27. Furthermore, macro tailwinds are strong, as the geosynthetics division is perfectly positioned to absorb massive upcoming Indian infrastructure and railway spending. The bottom line is that Garware is a fundamentally robust, cash-rich business, offering heavy downside protection alongside structural growth. So, what is your verdict? Is a 31 times price-to-earnings multiple fully justified for a debt-free market leader? Drop your thoughts in the comments below. If you found this Garware Technical Fibres earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.